I'm Mark Dunne, AJ Bell's Head of Research. And in this edition of our regular markets review, Breaking the Mould, I'm going to look at 3 high-profile companies all capable of making fuss in the coming week when they report. They are fund manager Aberdeen Asset Management, which offers a trading statement on Wednesday the 27th. FTSE 250 precision instruments maker Renishaw, which releases interims on Thursday the 28th. And finally, satellite broadcaster Sky, which unveils second quarter results on Friday the 29th. So let's start with Aberdeen Asset Management. Now, you may take the view that you don't want to own the stock and would rather just look at the funds it manages instead, depending on whether they fit your overall investment strategy, target returns, time horizon, and appetite for risk. That's a decision that only you can make. But Aberdeen is a stock worth keeping an eye on. Its commentary on fund inflows or outflows can give you a good feel for overall market sentiment, particularly when it comes to emerging markets, as Aberdeen has a powerful franchise here. Back at the time of November's full-year figures, the FTSE 100 firm revealed funds outflow for the year of £33 billion, and that included £12.7 billion in the final quarter alone, as assets under administration fell by 13% in the period to September. Management understandably cited negative market sentiment towards emerging markets as an explanation for the fund's outflows, and the chart behind me shows the stock does tend to be treated as a proxy for Asia, excluding Japan in particular, given Aberdeen's strong presence and track record in the region. For the statement on the 27th, watch the fund flow figures, and for the future, if they or Aberdeen's share price start to show positive momentum, that might be an interesting indicator for the emerging markets and broader risk profile overall. Note also the stock pays a dividend yield of some 8% right now, although earnings cover for the payout is pretty skimpy at 1.2 times. Our second potential fuss maker is Gloucestershire's Renishaw, where there is also a strong Asian flavour. The company is a leader in precision instruments used by customers to boost productivity and product quality in manufacturing. Returns on capital are good, the balance sheet is strong, and last year the firm recorded record sales and pre-tax profits, and yet the shares have been hammered over the past 12 months, as the chart behind me shows. October's trading statement was mixed, as the firm shaved down forecasts for the year by 4 to 5%, even as it kept profit targets. It may be British, but Renishaw gets just 5% of its sales from the UK, half comes from Asia, and a fifth from both the US and Europe. So the stock is seen as a bit of a macro proxy, and there's one other wrinkle. It has had great success supplying kit to Apple and Samsung, the world's leading smartphone makers. Now, there's quite a bit of anecdotal evidence to suggest this market is slowing down. Several Apple sub-suppliers have coughed up profit warnings, so keep an eye on quarterly figures from Apple itself on Tuesday the 26th of January. Note from this chart how the tech giant shares are down by around a quarter on last year's highs. For Renishaw, 4 years analysts now expect pre-tax profits to drop by a third to around £96 million, so that's your benchmark for the interims. And finally, we reached for the Sky, which is set to report Q2s on Friday the 29th. Unlike those of Aberdeen and Renishaw, the shares have actually been pretty resilient, surprising to some given BT has moved into its turf, as it were, by bidding for football content. Here's the chart. The market had been worried that competition for content would increase costs and cost Sky viewers, hitting profits, but the Q1s revealed a 6% rise in sales and a 10% advance in profits. For the Q2s, keep an eye on new customer adds, 134,000 in the first 3 months. New subscription additions, which came to 937,000 across all of its services in Q1. And any comments on the Italian and German operations. Sky's grip on content gives it pricing power, and it turns that into profits, cash flow and dividends. The shareholder payout has grown every year since 2014, and here's a chart to prove it. The forecast yield is over 3% with earnings cover of around 1.8 times. So let's see what Sky does with the interim dividend, which came in at 12.3p a year ago. Thank you for watching and look forward to seeing you next time.